Hello, everyone, and welcome to today's webinar, Emerging Market Infrastructure Debt Securities, Differentiated Fixed Income Hiding in Plain Sight. Today, we will hear from Devon Drew, founder and CEO of AssetLink, and Susan Wizialko, founder of Global Infrastructure Finance, LLC. Global Infrastructure Finance is an independent, employee-owned, female-led, institutionally funded emerging manager focused on infrastructure in emerging markets. This differentiated strategy actively manages hard currency emerging market corporate debt securities that support the development of infrastructure across emerging markets globally. The investment strategy is not capacity constrained and has produced among the highest returns in fixed income for more than 8 years. This sustainable strategy differentiates itself also by the strong positive impact it has on many people's lives by financing the delivery of critical human services. In this webinar, attendees will learn an introduction to the characteristics of infrastructure investing, differentiating features of liquid infrastructure debt versus private infrastructure debt, 3 criteria supporting emerging market corporate debt outperformance versus developed market debt, 4 reasons emerging market infrastructure debt will provide persistent, strong results, and 5 characteristics that make liquid emerging market infrastructure debt an attractive, high-yield investment today. The Investments in Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. It has also been approved for 1 CFP CE credit. Based on the information you provided during the registration process, Advisor Hub will submit your information for the CE credit. During today's presentation, there will be poll questions that will allow us to get your opinion on various topics. Should you have a question, please click the Q&A icon at the bottom of your screen, and we will do our best to answer it. And now, to kick us off, here's Devon Drew.
Patrick, thank you so much, and good afternoon, everyone. My name is Devon Drew, founder and CEO of AssetLink. AssetLink is a technology platform that allows financial advisors, registered investment advisors, multifamily offices, and family offices a platform to source, discover, diligence investment solutions such as Susan's strategy, Global Infrastructure Finance. Patrick, really appreciate it. Thank you, everybody, for joining us. Before we get started, we'd love to just get a quick pulse of the audience with the poll question, just to kind of see where everybody's head's at. Patrick, can you cue up the poll for us, please? For the first poll question, how do you use fixed income in your portfolio? Now, the choices are for liquidity, for income, diversification from U.S. equities, or a source of alpha. Now, Susan, I know you come from the institutional world. This is more private wealth. What do you think this answer is going to be if you had to put your financial advisor hat on?
Well, that's an excellent question, Devon. Thank you very much for the opportunity to join you this afternoon. I really appreciate it. Historically, there have been 3 major uses for fixed income in an investment portfolio. It's typically been income, liquidity, and diversification from U.S. equity portfolio holdings. But over the past decade, the income didn't really function very well because interest rates in the U.S. were at generational lows. In some parts of the developed markets, it was actually negative. So that didn't work so hot. The diversification from U.S. equities didn't work so well in 2022 either. It was the worst performing U.S. Treasury market since 1788, just before George Washington took over as president of the U.S. So that didn't work. Correlations went to 1. So most portfolios now use fixed income for liquidity purposes. And maybe now that fixed income is back, with rates at decades high, maybe there's a lot of liquidity in your fixed income portfolio. So maybe there's an opportunity to add some alpha.
Okay, so Patrick, let's see the results here. Wow. Okay. So 73% of the audience is using fixed income as diversification from US equities, followed by 52% for income, 25% for liquidity, and 13% as a source of alpha. Susan, what do you think here?
I think that's terrific because our strategy runs a fairly low correlation to US equities at 62%. Before 2020, it was running in the 30s, but after 2020 went to 62 over the 8-year period. And as a source of alpha, that's also incredibly interesting, as well as income, because the yield to maturity on the portfolio is 9%. And as a source of alpha, it's very differentiated. So I think we tick almost all the boxes. It was sort of a
Gotcha.
setup call.
So I think we have a good pulse. We have a good feel for what the audience is thinking. So I think this is a great time to introduce Susan Wizialko and allow you to kind of introduce yourself and the firm and why are we here today. So we'd love to pass it along to Susan.
Thank you so much, Devon. I really appreciate the opportunity to be here with you this afternoon to share my passion for investing in emerging market debt that supports the development of infrastructure. Now, that's a huge mouthful, and what we're going to do is unpack that slowly over the next 45 minutes. I would really love for this to be interactive, so if you have any questions, please feel free to add them in the chat box at any point in time. I welcome them. I wanted to briefly introduce my firm. We were created to purchase listed bonds with a daily market price that support the development of infrastructure across EM, and I'm going to explain why. My business partner, Chris Papetti, and I are a GMO spinout. We worked together at GMO for the 11 years I was there. He was there for over 21 years. And what he did there was he runs our firm. He basically ran a staff of 14 people, took care of daily pricing of over 7,000 securities, created some of the operating systems of the firm, and took care of the audits, the SEC audits and the external audits. So he has our firm operationally buttoned down very tight. So I don't have to worry about anything. I get to focus exclusively on the investment portfolio. And I'm super excited. It's worked just incredibly well. I thought it might be helpful to explain a little bit of the types of bonds that we might buy. Might be senior debt, dollar debt from the South African Electricity Company. Or it might be a subordinated bond, again, a dollar bond, issued by the Peruvian Development Bank. Or alternatively, we could be talking about project financing bonds, where the revenues from the project are what's available to pay off the bond and the debt service. And that might be for an electricity generation plant in Indonesia or a toll road in Jamaica. But before we go too far, I would like to just take a minute to make sure definitionally we're on the same page. So what is infrastructure? Essentially, I think of infrastructure as the physical systems needed to run an economy. Now, the government might designate this as critical infrastructure, meaning something so important that the government or a municipal government has to own it. It could be social infrastructure, which would include human services like healthcare coverage, hospitals, or colleges and universities, or secondary schools. Or it could be bonds that support what we call hard infrastructure, transportation networks, or telecommunications, and that kind of stuff. I'd like to spend a moment talking about the investment characteristics of infrastructure and how it contributes to good credit performance. Again, we talked about the critical services, but if you think about it, if you're a government and you want if you're a government, your objective is generally to remain in power. Whether you're democratically elected or benignly despotic, you need to keep the voters happy. How do you do that? You provide basic human services, electricity, everyone needs that, transmission, distribution, and generation, telecommunication services, healthcare delivery, water and sewer systems. All of this is required to keep people happy. But there's an additional component of infrastructure that makes it very attractive from a credit perspective, in that the assets are used by other entities to produce revenues. What I mean by that is if you like to invest in emerging market equities, you're going to love emerging market infrastructure debt, because emerging market infrastructure debt provides the systems that those companies use to produce their product or service. And it also supports the functioning of the government itself. So for these reasons, it's often the case that infrastructure debt outperforms non-financial corporate debt from a credit perspective. Moody's has a 37-year study, which we're happy to share if you don't have it directly, that shows that infrastructure debt, whether in developed markets or emerging markets, performs better than non-financial corporate debt because default rates are lower and recovery rates are higher. And I'm confident that part of the reason for that is the critical nature of the services provided.
Susan,
Now,
Susan, that's really good, and thanks for talking about, you know, the characteristics. But just curious, we do have a question that popped up. What percentage of the portfolio is dollar denominated?
100% of the portfolio is dollar denominated. We don't take local currency risk.
Okay,
Also, the reason for that is we don't take local law risk. So all of the bonds are either US or UK law securities. And you can't get, typically it's very hard to get dollar assets without local law.
So you mentioned some characteristics and highlighted why infrastructure potentially is a good investment opportunity and why it's hard to get some of the exposures. But from a characteristic standpoint, I'll jump around here. What makes it attractive for your strategy kind of right now, based off some of the characteristics you mentioned?
I'm going to focus on more characteristics, but maybe cash flow from a cash flow perspective. I'm actually a structured finance. I grew up in US structured finance. So the things that are highly attractive to me are the fact that we discussed the critical nature of the services provided, but the cash flows are long-term in nature and visible. The tariffs are often regulated. Revenues are predictable, stable, and usually contracted. And what I mean by contracted is that the electricity company generally doesn't construct the generation plant until the offtake or the purchasers of electricity are already contracted and in place. So for that reason, the cash flow stream over the life of the project is very visible, measurable, reliable, and it's easier to take on a heavier debt load because of those features. The project financing bonds that we participate in generally have pass-throughs to the operating company for fuel costs. So if natural gas or oil or whatever the fuel cost is, and that changes significantly over time, the increase in price is passed through. It also adjusts for inflation, local inflation, as well as US inflation, and the FX differential between the local denomination currency and dollars, because revenues are typically earned in local currency, and the financing source is dollars. So that could be theoretically a credit issue, but as we've seen over the past year and a half, we've had a very strong dollar. We've had extremely high inflation, especially in emerging markets, and all of these projects are performing quite well.
No, thank you for that. And we do have another question, if that's okay with you.
Certainly. It's so much better to have questions that I know people are still there.
Yeah, absolutely. So was there ever a time when you were investing in the asset class where you were bearish and said so? My experience with investors in niche asset classes is that they're always bullish on asset class, and it always looks cheap.
Well, I'll be honest, it's not always cheap, but I am always bullish. You're right. That's a fair comment, and I respect that, because I have a passion for this investment. And if I'm running a concentrated portfolio of 25 to 35 exposures, I'm always going to be able to find undervalued bonds, I think. I mean, I talk with my colleague about, it's like finding shells on the beach. Sometimes the bonds sell off for reasons that have nothing to do with the issuer's ability to repay. Geopolitical risk, structural risk, liquidity hiccups in the treasury market, all of these things cause emerging market bonds to sell off. And when that happens, if you're a good fundamental credit analyst and you know what things should be priced at, or what our metric is, and I'll explain that in a moment, then you see literally the landscape is littered with undervalued securities, and there's an opportunity to go and pick them up and just wait for the market to adjust. So it's fair. I'm almost always excited about the asset class. I will be candid whether it's cheap or expensive. Right now, I think it's not super cheap, but it definitely is undervalued, I believe, from a spread level perspective. And I'll cite for you The spread on our portfolio, the Z spread, is approximately 400 basis points, whereas the Z spread on the semi-broad diversified, the index, the JP Morgan EM corporate bond index that we measure to and run a 95% correlation with, has a Z spread of about 215. So the delta between 400 and 215 gives us a lot more room for spread compression and capital appreciation than the index. So
Yeah,
that's why I think it's undervalued.
so why do you think that that listed bonds are a good way to get exposure to infrastructure debt returns?
Well, we just discussed the characteristics of infrastructure from a cash flow perspective, visibility, long-term, reliable, and then we talked about why governments are predisposed to support the issuers, whether or not they own the issuers. Today, if you're an institutional investor and you want exposure to infrastructure debt, you're pretty much limited to developed market and private assets. And the problem with that, according to Preqin, was at the end of 2023, there was 345 billion of dry powder. So committed and undeployed capital waiting to be invested in projects. Now, I'm not a private asset developed market infrastructure specialist, but I would hypothesize if you got a lot of money, 3 years worth of deployment, chasing too few projects, returns will have to disappoint. What we do is we look in a different geography altogether, emerging markets, where very few people are looking on a pan-EM basis. And we also look with a different security. So instead of buying the asset itself, we buy a US or UK law bond security, where if it goes bad, the remediation process is well understood. So the attractive features make it a very popular investment, as we can see with all the dry powder in developed markets. But by looking where others are not, we can get the same returns or very similar returns to private asset developed market infrastructure, but with much better liquidity. So you don't have to, if you invest in our strategy, listed bonds, for example, you don't have to put your money away for 3, 5, or 10 years. You can get it back in 6 months. And I can't figure out how to advance these slides because it is not moving.
Yeah, Patrick, if you could do us a favor, and while you're figuring out the slides, we do have another question. So, Susan, how much exposure did you have, if any, in Sri Lanka after the COVID crisis?
That's a good question. We did not have any infrastructure exposure in Sri Lanka at all. I haven't seen much corporate issuance out of Sri Lanka. You have to understand that EM is not a homogeneous class. So you have a lot of people think EM is a homogeneous investment class. Within emerging markets, there's humongous, that's a technical term. There's a lot of variability in economic possibilities and outcomes. Sri Lanka is at the more lower development stage, meaning there's a lot of sovereign debt outstanding, but I haven't seen a lot of corporate issuance. When I was at GMO, we saw some of the banks issuing, but very little. So it's mostly sovereign issuance. We weren't able to get there. Our asset class is in a middle to higher tier of EM countries is where it comes from, in my view. I mean, our portfolio, as I said, was between 25 and 35 exposures. The average credit quality is BB plus ballpark. The range is from A3 or A- all the way to default. So that's what's in the pool.
Gotcha. And you might get to this a little later, so let me know if you do. So you clearly don't favor Sri Lanka, but what countries do you currently favor?
Oh, well, we have today 32 exposures in 19 different countries. I do have a pie chart later. If you don't mind, I'll wait till we get to the pie chart, or you want me to flip down
Sounds
there?
good. We'll wait and we'll let you get on with your presentation. Thank you.
Awesome. Well, I appreciate the questions, so keep them coming. It keeps it way more interesting. 5 characteristics which make liquid EM infrastructure debt an attractive high yield investment today. I might actually give you 6 because there has to be a benefit for you participating in the webinar. There's no J curve, meaning you don't have to wait to put your money to work. There are attractive investment opportunities right away. You get a much less concentrated portfolio, especially with smaller invested amounts. Typically, infrastructure investing can be very lumpy. And this is a nice way to have a much more diversified exposures. You get superior liquidity. I think you can get, as I mentioned, we have a open-ended commingled GP-LP structure. So it's open-ended commingled fund. And the idea is that you need 6 months to get out. And you might say, Susan, why do you need 6 months to get out? Because they're listed bonds with a daily market price. And the point here is that we want to be sure that if somebody wants to get out, we don't have to sell the most liquid securities just to get people out. We want to respect the people who are remaining in. And 6 months is an adequate amount of time. Under normal operating procedure, we should be able to get you out way faster. But if it's March of 2020 and the portfolio is down 14.3% on the month, only because of a liquidity squeeze, nothing wrong with the credit. We don't want you redeeming at a 14.3% loss. If you waited till September of 2020, it was back to par. And if you waited till December, it was up 16.8% for the year, gross, 13.7 net of stated fees, which was quite remarkable even for me. You get much transparent and timely investment valuations. So every day you know what your assets are worth. And you get better downside protection. As I mentioned before, what we're buying is a US or UK law security. Now, I did mention I was going to give you an extra item. And I think that's the characteristic is I truly believe that EM infrastructure debt bonds will continue to sell off for reasons that have nothing to do with the issuer's ability to repay. And when that happens, if you've set up a good fair value and you know what that should be, and the market deviates from that, you just buy it and wait. Again, it goes down to the shells on the beach analogy. And Patrick, I'm going to ask, there we go. The other thing too is that there's really ample opportunity. And what I mean by that is that this is not a capacity constrained strategy. We estimate that the total infrastructure related hard currency corporate bonds outstanding are 1.4 trillion. That's exactly the same size as the amount of sovereign dollar debt bonds outstanding, 1.4 trillion. So it's not really, it is a niche strategy, but it's not a small niche strategy is what I'm trying to say. 1.4 trillion is also the amount of US CLOs outstanding. So if nobody thinks US CLOs are a niche market, then EM corporate infrastructure related corporate bonds shouldn't be either.
So why do you think, so a question that I have is, why do you think that EM corporates will outperform that developed market corporates?
I'm going to ask Patrick if he doesn't mind, please advancing the slide. For some reason, the button isn't working here. I'm going to give you three reasons why EM corporates will outperform developed markets or advanced economies. Number one is you get among the highest returns in fixed income. And if Patrick, you don't mind changing the slide forward one, please. You can see from Bloomberg Intelligence from early April, high yield EM corporate debt has a 9% yield to maturity, yield to worst, 10% for EM high yield sovereign debt. So it's a group that has among the highest returns of all the major fixed income asset classes. Patrick, if you don't mind going back one, please.
Yep.
Back one. There we go. Thank you. So it has the highest returns in fixed income. It has higher GDP growth. So if we can go forward too, please. Higher GDP growth is going to lead to stronger returns. One more forward, please. You can see in 2024, advanced economy GDP is about 1.8% forecast for this year, whereas emerging markets are forecast at 4%. That's more than twice. And stronger growth is going to lead to stronger returns. If you also think about the population dynamics in emerging markets, if they have much younger populations, they have a lower level of development, meaning they have a lot more development to go, and all of that will need financing. Governments don't have the economic capacity to finance all the infrastructure development that's required. They must have the private sector participate. And that doesn't even consider climate change related infrastructure. When you layer that on, the amount of possibilities or opportunity set is really huge. Could you please go forward one more, Patrick? The third reason that emerging market corporate bonds are going to outperform developed market corporate bonds is because the economic fiscal is really good shape, is improving. So a couple things are going on here. Number one, central banks in emerging markets were way ahead of developed market central banks in hiking interest rates. EM central banks have a lot of experience in dealing with inflation, and they began hiking as early as 2021, whereas developed markets took a long time to follow. As a result, emerging market central banks have been cutting interest rates already, in some cases as early as last July. So the Central Bank of Chile started cutting interest rates last July, and they cut 100 basis points to 10.45%. They've cut 5.25% out already, so their rates are down to 6. That rate cut is going to help to stimulate GDP domestically. Like Chile, Brazil, Czech Republic, they've all been cutting rates. Developed markets, it was only in June that the ECB and the Bank of Canada each cut rates the first week of June by 25 basis points each, and we're still waiting for the Fed. I'm not worried, honestly, about higher for longer with the Fed, because that will just mean we will have higher coupons that we will collect over time. In ballpark, approximately 2/3 of our return typically comes from coupon income. 1/3 of our return typically comes from spread compression or capital appreciation. And I think that supports our allegation that we're good at finding undervalued bonds. So we've got a macro situation that's improving. We've got a credit situation in emerging markets that's improving. Credit outlooks and credit changes have all been swayed to the positive in aggregate. Of course, there are exceptions to every rule, but in aggregate, the credit picture and the macro picture is looking better. Lastly, liquidity is still good because year to date, emerging market corporate debt issuance is double the volume of emerging market corporate debt issuance from last year. And that shows that the market is open and liquidity is available to these entities.
And thank you for that. We do have a question here. So you talk about high yield relative to the rest of the world, and there is a reason for that. Now, GS in Indonesia comes to mind. How do you avoid being embroiled in corruption with a local company?
Okay, so that's an excellent question. And that's been a problem a lot of people have in working in emerging markets. We have always considered ourselves to be an ESG aware policy, system, strategy. We've never billed ourselves as an ESG fund because we've always been very hesitant and worried about greenwashing because a lot of people do that. So we figured until we had a measurable, externally auditable process, we weren't going to claim that. So what we try to do is we try to avoid as much as we can issues with corruption. What I mean by that is, honestly, I think one of our competitive advantages is our ability to do due diligence with management teams. I've been advised not to share this story, but I still do anyway.
Share it. No, we're good here.
Yeah, they said, Susan, you'll scare your investors away. I'm like, it was true. So in one time I was talking to a debut issuer and they were in my conference room talking to me about their transaction. And the guy, actually the CFO, admitted customs tax fraud to me in the conversation. I'm like, wow. So your bond now fair value goes to NAAP, not at any price, because if that's what they're doing before they get your money, imagine what's going to happen after they get your money. Like, life's too short. So we tried to avoid situations like that. There was a case where the Panama airport was issuing a bond, and I asked the management team, so how did Panama Papers affect you, if at all? And the answer was, oh, no problem. Everything was good. Okay, great. Well, don't you know that just before pricing, oh, turns out someone on the board was implicated in the Panama Papers, and the issuer, the debt capital markets banker, had to pull the transaction, reissue it at a higher coupon. So we try to avoid as much as we can. We will never be able to avoid all the problems and all the corruption in emerging markets. But what saves us a little bit is the fact that, remember all of those characteristics we talked about with regard to infrastructure, how governments need them to run their companies and run the government? That basically makes sure that you're still going to get paid if what your issuer is doing lines up with the objectives of the government. You will continue to be paid independent of who's in power. And that's why I like infrastructure. Does that make sense? Do you think I answered that question okay?
I think so. Just curious about your analyst tenure in what geographies you guys have a stronghold in. I know you mentioned due diligence. Do you guys have a set number of due diligence meetings you do? Do you spend time within country, or do they come out to Boston?
This is one of my little pet peeves. So normally issuers will all come to Boston. And historically, that was one of our competitive advantages because it was a big enough place that issuers could come and see a lot of money in a day, which was great. But it wasn't as big as New York, which was so crowded, you would have to do 2-on-1 or 3-on-1, 3 investors per issuer. So we think we excel at that investor due diligence, as I alluded to earlier, because we always think of management's time as a gift, and we over prepare for that, and we try to understand the strategy of the company and how it fits in with the government's objectives. And post-COVID, a lot of issuers are not roadshowing. They do investor calls where me and 8 of my dearest competitors are all on the call asking questions at the same time. So I'm not really happy about that. I think that's a bad fact. I've been lobbying the debt capital markets bankers to have more roadshows. Issuers need to get on the road, especially the IG, the investment grade ones are saying, look, we're investment grade, we don't need to. I'm like, I don't think that's true. So now what we're doing is we're taking steps to go out of our way. If we don't see them at one of the emerging market corporate conferences that we attend each year, we're going to end up calling up the IR department, scheduling our own hour due diligence with the management team in order to get that done, because that's critically important. And I think over time, if fewer people don't do that, there's going to be even more opportunity, because good credit people are getting harder and harder to find. And if the issuers reduced the opportunities for interaction with them, I think it's going to be problematic. That's just my view.
Gotcha. So I think it's a good time, and thanks for answering those. So let's take a quick step back. And Patrick, if you could put up the second polling question, I think that'd be great. So the second polling question: how do you use emerging markets in your portfolio? Now the choices are: we invest in EM equities, we invest in EM debt, we invest in EM rates or FX, or we are not investing in emerging markets. So Susan, I know you're very biased. Once again, putting on your financial advisor hat, what do you think this answer is going to be?
I think honestly, institutionally, investors are underinvested in EM, whether it's EM debt or EM equities. If you look at EM debt, for example, it's about 20% of the US debt capital markets, but it typically only is represented by 1 or 2% in any investor's portfolio. So it's definitely underinvested.
I'm gonna go with 1 EM equities. That's where I'm gonna go with this. So Patrick, if you could do us a favor and put the answers up.
Well done.
So 66% we invest in EM equities. I've been doing this a long time, but 25% we invest in EM debt, 2% EM rates and or FX, and 31% we are not invested in EM. Right.
Awesome.
So I guess we're both right on this. So what do you think for the people that aren't invested in EM, or the people that choose equity over debt?
The people who choose equity over debt, I am not surprised, because typically that's what happens. But I think in EM specifically, it's really hard to get EM equities right, because you have to get the macro call for the dollar. You need to get the dollar rates call and the local rates call correct, because it's my understanding, and I'm not an EM equity specialist by any stretch, so it's just my hypothesis, that the majority of the returns in EM equities comes from the FX. So if you buy the currency when it's really undervalued and you don't mess up the credit, you should be okay. But I think in my experience, my limited PA experience with EM equities, it's very hard to get that right consistently. Whereas EM debt is a lot easier. It's dollar denominated and you're just focused on specific credits.
And the people that have no EM exposure.
I respect that. If you don't understand something, you shouldn't be invested in it. That's very safe. And I am grateful that 31% of the population on the call who don't invest in EM decided to dial in and learn something new. So thank you very much. I appreciate your time. I'm going to ask Patrick to please advance. I thought it might be helpful to do briefly a case study. Don't panic. I'm not going through all the words on the slide. I just put it up there so you can see the things that we look at. And what I'd like to do is spend 3 minutes talking about an issue in June of 2015 that was for AES Panama due 2022, a corporate bond, 7-year corporate bond. And it was basically, in a nutshell, the reason this was a really attractive bond is because it had survived a perfect storm of 3 bad things that had happened to the company. None of them were fatal, but because they had bad stuff happen in the 2 years prior to the bond issuance, and they had to issue the bond to take out maturing debt, so they had to roll debt, and this was like the lender of last resort, the international debt capital markets. They had to pay up to get the bond done. And I'll tell you briefly the 3 bad things that happened to the company before it issued. Number 1, AES Panama was about 20% of the electricity in Panama at the time. The company was majority owned by the Panamanian government, 50.4%, with a remainder owned by AES Corporation. At the time, had 35 megawatts of electricity generation, transmission, and distribution in 18 countries. Now it's an investment grade company with operations in a dozen countries and about the same size. So its credit has improved, but doesn't really matter. So it was 20% of the system. And in Panama at the time, it had no capacity reserve ratio, meaning peak demand was exactly what the system could cover. Most systems have a 20% cushion. So peak demand is usually 20% capacity on top of that. And that wasn't the case here. So number 1, there was no excess capacity in the system. Number 2, the government wanted more generation capacity, but didn't want to spend the money itself. So it had to have an attractive regulatory environment. Number 3, the fuel for AES Panama was hydropower, and they were coming off the worst drought in 40 years. What that meant was the company was 89% contracted, which means they had already sold 89% of their annual production capacity, but without enough water, they couldn't produce to deliver what they owed contractually. So they had to go into the spot market to buy electricity to meet their contractual obligations. The problem was that the entity managing the electricity dispatch, which is supposed to be dispatched on cheapest to deliver, meaning you buy electricity from the most cost-effective producers at the time. The government, which does that managing, decided to make an executive decision to conserve water and dispatched higher cost electricity, which made the spot price go from $100 per megawatt hour to $300 per megawatt hour. These people were losing money in every megawatt they sold. The company went back to the government and said, hey, guys, help. You're making these decisions. We're losing money. Government said, you're right. They took them to court, and the government said, you're right. We'll give you $40 million over the next 2 years. So all of those things together said, this bond is going to come. Can we turn the page, please? Next slide. The bond actually came, we think, 75 basis points cheap to fair value. We look at a metric called the Z-spread over comparable duration sovereign bond. That is a very simple statistic. It's what you get paid to own the credit there. And we look at the spread over comparable duration sovereign because that's what you're getting paid to own that company. And on every bond we look at, we take all the information that we talked about, and we take the structuring information, and we set a fair value for that security. And in this case, it was 225 over comparable duration sovereign. Came cheap by 75 basis points, so we bought it. We kept it for 2.5 years. And over that time period, the spread over comparable duration tightened up to about 150 when we sold it 2.5 years later. We didn't trade in the bond during the time. We bought it and we held it. We clipped the coupon. Over that period of time that we owned it, it was a 20% return, of which the income was 16% and the price was 4% of the total. That was 800 basis points more than comparable duration sovereign bond. And basically, it was the best performing Panamanian bond on the street in that period of time. But once we sold it, we continued to watch it. And a year later, we bought it again because spreads had widened out. So we said, oh, this will be great. And we held it for 4 months before we sold it again. Again, from 11.2318 to 3.2319, had a total return that exceeded comparable duration sovereign. That metric, spread over comparable duration sovereign, is easily identifiable. It's simple to do. We don't use any leverage. It's not fancy. It's very easy to understand. And that is how we set fair value, and that's how we choose our bonds.
And Susan, we have a couple more questions that came in, if that's okay with you.
Certainly.
So a question that came in is what factors also evaluate when it comes to reviewing opportunities specifically around China? They've been giving lots of capital to developing countries.
I will answer it in 2 parts. One, what information do we look at? I'll do that really briefly. We go through the offering memorandum. I am fortunate because I grew up in US securitization industry. What that means is I have a different perspective and viewpoint than a lot of other emerging market corporate credit analysts or PMs. Most of my competitors are organized either on an industry or geographic basis. I was trained in asset securitization, meaning the documentation taught me I spent 5 years at S&P securitizing every type of consumer receivable and commercial receivable. I ended up heading up the asset-backed commercial paper market group. And that was awesome because they would do all the new and exciting innovative assets. The reason for that is the liquidity facility the banks would provide would take risks that the debt capital markets couldn't take. So I learned about innovation, I learned about cash flows, I learned how things can go wrong, I learned how structure can mitigate risk. I take all of that and I mix that with my emerging market political economic risk hats. I review the offering memorandum, I review external research, I review local market newspapers, sometimes online. All of those things go into what we do to set a fair value for that bond. And we will set a fair value spread over comparable duration sovereign. So there's a lot of information that goes into what do we do in conjunction with management interview, due diligence to set a fair value. Specifically to the China question, China is the one market where we currently don't invest at all. And there's nothing to do with political. We don't take political views here. We are the view that everything has a price. But with regard to China, we learned when we were doing a management due diligence that there's a clause in every single bond prospectus that says senior bondholder interest is preference to items is reduced to items preferenced by law, meaning the priorities that come ahead of senior bondholder interest. In the vast majority of the world are 2 things: wages owed to employees and taxes owed to the government, and then comes senior bondholder interest. But in China's case, the list of items that come before senior bondholder interest is half a page long. So we figured we aren't getting paid. We're getting an equity risk and we're getting a debt return. And that seemed like a bad trade. And that was true for onshore issuers or offshore issuers. So as a result, we don't buy any Chinese bonds, onshore, offshore, nothing. We don't get involved there because we're not getting paid adequately for the risk.
Oh, thank you for that. Can you go into a little bit about the strategy, why you created it, what makes your strategy different from other EM infrastructure funds?
Sure. Well, nobody is looking at EM infrastructure debt. Nobody's looking at just infrastructure. People might look at EM corporates, but no one's looking at EM infrastructure. And for all those reasons we talked about at the very beginning about why infrastructure is an attractive risk reward parameter and why so many developed market investors want infrastructure debt returns, it's also true in EM. You just exhibit your view differently. I will show you that I'm going to just briefly comment on this. We were fortunate that eVestment shared this with us, and I am greatly appreciative of that since I don't pay eVestment for the data. But what it shows is that we have consistently outperformed the SMB Broad Diversified. They told us in March when they gave us this information that for the 8 years ended February 29th, 2024, we were number 2 for alpha generation among 58 funds over the 8-year period. And we're very excited and jazzed up about that. The tracking error, I want to point out, is very high. And although we have a 95% correlation to the SMB Broad Diversified, the JP Morgan EM Corporate Dollar Debt Index, the high tracking error shows that our revenue stream, our income stream, is truly differentiated. So I'm just excited and wanted to share that. I'm not going to go through these numbers. I did want to show you what the variability looks like in the performance. Last year, we posted a 13.3% gross return, 11% net of stated fees. We think that fundamentals, technicals, and spread levels all contribute to setting up for another year of double-digit returns in 2024, in our view. I also wanted to show on the next page, I had promised the geographic split. You can see 56% of our portfolio is in Latin America. That's overweight versus the index, where about 25% is there. But we find a lot of security selection opportunities, and that's why we go where we think it's undervalued. 18% of the portfolio is in Asia, and none of that is in China. You can see that in the middle, the allocation by issuer type, half of the portfolio is corporate senior debt, a third of the portfolio is project financing debt, and 17% is non-corporate senior debt. And then you can see on the right-hand side how the assets settle out. Electricity is half of the portfolio, but candidly, I don't think that's an industry risk. The reason for that is electricity risk is regulatory risk, and that 50% is a dozen countries. So that's well diversified. Transportation assets got a little higher in the time of COVID. A lot of them got really cheap, so we increased our transportation assets at that point in time. And if, Patrick, you don't mind advancing one slide, I would appreciate that. On the far right, you can see the strategy return contributions. This shows that 77% over the 8-year period came from coupon income and 38% came from spread compression or capital appreciation. You can see the negative 21% drag over the life due to US Treasury impact, mostly 2022. But the indications for 2023 are more typical on the left-hand side of the slide. And if you don't mind advancing one slide, please. Devon, to answer your specific question, I said before how most other institutional EM corporate credit people are organized by either geography or by asset class. We aren't. Why am I doing this? I know that we can be the #1 performing EM corporate credit fund on the street. And we have delivered everything institutional investors have asked of us. We have an independent firm, which is employee owned, majority female led. We have differentiated asset class with regulatory tailwinds, institutionally funded. We delivered everything that we've been asked to deliver. But the feedback we get from institutional investors are, for example, oh, we need to see 3 years of live track record in order to invest in you. And normally that's fine, but this investor has been getting our monthly investor report for over 4 years. So he's seen it built live. Or we might get feedback like, oh, gee, this is really cool. We really like this, but you have a GP-LP structure, which is a private asset, but your assets are listed securities, they're public. You don't fit in our box. We don't know how to look at you, so we're going to just watch you. To which I would politely and respectfully respond that it's the truly outside the box people who are going to create a significant source of alpha, in my view. Or my all-time favorite feedback is senior management doesn't have appetite for this strategy at this time because you don't look or sound like what we were expecting. I think that we are living the American dream. We are working very hard to show people what we can do. It makes me think about the story of FedEx, where I had understood when the founder early in the life of FedEx needed $50,000 to make payroll. But when I tried to verify the story online, it said he needed $26,000 to meet supplier payments. Either way, he took the last $5,000 the company had and went to Las Vegas, and on the blackjack table got the $26,000 he needed to pay off his suppliers and kept the company alive for another week. That was a pivotal point in FedEx's history, where from that point on, things changed and it all started to go his way. So the point is, it gives me hope that sometimes unicorns, which are standing right in front of you, are not visible. I have really enjoyed the opportunity to speak with all of you today and have the chance to share my passion for investing in this asset class.
Yeah,
I'm
and
really grateful, and I would be delighted to turn it back to you for the third poll question.
so before the poll question, so we have 9 minutes left, and we have a good amount of questions that came in. So would love to get the questions for the last 9 minutes of the webinar. A question that came in a little while ago was if you can get one-on-one traditional roadshow, why can't you get a one-on-one on Zoom?
That's a very good question. I don't know. What I've been told, that's a very good question. But what I've been told by management is issuers prefer to do the group one-on-ones on Zoom because they can see more managers and more efficiently.
So it sounds like they're lazy.
I'm never going to say that.
No, I'm just kidding. But no, thank you for that. Thank you for that answer. And hopefully that answered your question, Jeffrey. Another question that came in: how do you see the current political climate, first in the Trump administration with tariffs, and now Biden following through on this? Will it impact the emerging markets?
You know, this is a great question, and I feel incredibly fortunate because I am not a political analyst, and all I need to worry about is spread over comparable duration sovereign, because I know what fair value should be, and as when the market deviates from that, that's what I stick with. One of my competitors earlier this year was talking about how the massive amount of voting that's going to take place in the globe in democratic countries over the year. And that's true. There's a lot of potential for change or disruption or opportunity, but I have no competitive advantage in that regard. I can't forecast what's going to happen in India or South Africa, where they had shocking, or even Mexico, where it was so good the market sold off because they were worried they had a supermajority and was not going to be good for institutional investors. I can't control any of that. All I can understand is spread over comparable duration sovereign, and I stick to that. And that is a mean reverting factor, I believe, and that keeps me out of trouble. So I'm gonna sidestep the whole Biden-Trump question.
Gotcha. And what is your standard deviation versus Barclays?
I don't, off the top of my head, know what it is versus the Barclays Ag. I can tell you that standard deviation on the portfolio over the 8-year period is, for the whole 8-year period, is about 0.5. For the last 12 months, it's 0.8.
Gotcha. Thank you for that. And then how can folks reach you, meet with you, and how could they get access to your strategy?
I would welcome a call, a chance. If you want to learn more, see more case studies, have a chat, meet the whole team, I'd be delighted and honored for any interest in the strategy. My information is here on the screen, email, phone number, our website. Please check it out. My LinkedIn has some, I think, pretty cool research pieces that were posted. One was time-stamped on St. Patrick's Day in 2020 about how this was a nice opportunity to invest right then at the moment, and how many people would miss it because they were scared and didn't know what to do. But that is when you make a lot of money, when the market sells off. And it's critical to me that institutional investors understand the strategy. So when the market sells off 14%, like it did in March of 2020, I'm going to call you up if you're invested in our strategy and say, I need more money. These are the opportunities we're seeing, and this is where I would like to deploy the cash. So when the market sells off is when I'm going to come back and ask you to stick with it. So it's critical that you know that up front and you like that, because that's how we make a lot of money. I actually was at a seminar last week, Thursday and Friday, a fixed income seminar, and we were talking to the ETF people, and he was trying to get us to issue ETFs, and I'm like, what's the AUM you need? I said, this is not a retail product, because retail will sell at the exact wrong time. And it's the minimum ticket size to buy one of these bonds is $200,000. And the reason for that is to keep mom and pop out. So I said, so I told the ETF guy, this is not an appropriate retail product. And he said, wow, that's really refreshing. And then he went on a long rant about private credit and how they're looking to offload it into retail. And I'm like, but they'll do it at exactly the wrong time, because the credit fundamentals of private credit are about to deteriorate massively. And he said, yes. And I thought that was crappy.
Is there any vehicles you're currently exploring other than the GPLP structure? I know I've seen some, you've seen like interval funds or semi-liquid type products that have, that have come into the market. Have you explored anything, whether it's CIT or whatever have you?
We are pragmatic, and our goal is to create a balanced amount of AUM. We want more AUM so we can catalyze that pipeline of 350 institutional investors who get our quarterly investor letter. And we have had conversations with them about when they want to come in at different entry points. So we are pragmatic about accomplishing our desired objective.
Gotcha.
But to answer the question directly, we haven't formally explored interval funds or other types of structure. We had set this up as a GPLP master feeder, where the Delaware entity is the feeder, and ultimately there'd be a master in Cayman, but we didn't set that up yet. We won't set that up until we have significant offshore interest that would require it. The cost to do that doesn't make sense without assets.
Gotcha. Thank you. And a question from Michael. So with the shift with the petrodollar, any thoughts on Enbridge and its long-term effect on the emerging markets?
I'm sorry, I'm not understanding Enbridge.
Okay, so Michael, if you could do us a favor and tell us what Enbridge is. I'm not familiar with it as well, but do you have any thoughts on the petrodollar and effects on emerging markets?
So a lot of oil exporters, Saudi Arabia, Colombia, UAE more in Saudi Arabia actually, have been working hard to try to diversify their economies with so far mixed results. Ultimately, long term, it's a really good idea to diversify your economy away from carbon. But as I said, so far mixed results. We take a pragmatic view towards ESG and carbon. I view ESG like I view my children. As long as they're making progress in a positive direction, it's all good. We think that this is the most pragmatic way to deal with oil, gas, and carbon in emerging markets. It's very hard to separate emerging markets from oil and gas. A lot of countries export a lot of that, and they need that to continue to subsist. But in a country like Indonesia, where when we started investing in electricity there, 100% of the population did not have access to electricity on a consistent basis, we are happy to finance a coal-fired plant because that's what they can get. They don't 100% of the people didn't have it. But in another country with a different level of development and different regulatory level of development, like Chile, we are happy to finance Chilean electricity generators who are moving from carbon to renewables, each according to their ability and making progress in a positive way.
Awesome. Thanks for that. So that actually wraps up our time for today. So we really appreciate all of the audience members who took the time out of their day to listen to myself, Devon Drew, founder and CEO of AssetLink, and Susan Wizialko of Global Infrastructure Finance. Please, what we're going to do is send you out a survey question right after this, and we would appreciate if you could give us a response, allow us to get better to serve you. Of course, if anyone wants to meet with Susan, we'll give you that option as well. And also an opportunity to get her slides and additional information on her product. You could also access Susan via AssetLink on app.assetlink.ai. and we look forward to seeing you on the next webinar. So on behalf of myself and Susan and Patrick and Advisor Hub, we thank you for the time today.
Thank you very much.